Good day, everyone. We are now on the next part of the discussion with financial statement analysis. And this time, we'll proceed with financial ratios. There are a lot of ways to analyze financial statements, and the most applied one is the financial ratios. So financial ratios is a comparison in fraction, proportion, decimal, or percentage of two significant figures taken from financial statements. This basically means that we are taking figures actually posted in financial statements and compares it in fraction, proportion, decimal, or percentage. It also expresses the direct relationship between two or more quantities in the balance sheet and in income statement of a business firm. So, financial ratios are categorized based on your book into five. These are the liquidity ratios, which are used to measure a firm's ability to meet short-term obligations, the asset management ratios, which measures how efficiently the firm is using its assets, the debt management ratios, which measures how effectively a firm manages its debt, profitability, which measures the profitability of operating and utilizing the assets of the firm, and lastly, the market book ratios, which brings in the stock price and give us an idea of what investors think about the firm and its future prospects. So ayun nga, yung market book ratios, it tells us what investors think about the company and its prospects. These are usually used yung market book ratios for listed companies registered in Securities and Exchange Commission and is also in stock exchange. There are more categories of financial ratios other than these, but for the purposes of this discussion, we'll stick with what is in your book for common reference. So let's start with liquidity ratios. These are ratios used to evaluate short-term financial position or short-term solvency and liquidity. So liquidity ratios gives us an idea of the firm's ability to pay off debts that are maturing within a year or within the next operating cycle. It shows the relationship of a firm's cash and other current assets to its current liabilities. So, for liquidity ratios, karamihan sa mga formulas na ma-encounter nyo dito is from the balance sheet, yung figures. So, these are necessary if the firm is to continue operating. Ayun. Para malaman natin kung yung firm is makakapag-operate pa in the future. Ayan, gumagamit yung mga financial analysts ng liquidity ratios to know about it. So, liquidity ratios help answering, a firm, will the firm be able to pay off its debt when they become due? So, kaya ba makabayad ng firm kapag yung utang niya is due na, and kapag binayaran niya ba yun, makakapag-continue pa yung firm with its operation. So, kapag yung answer for that is no, ayun, need natin i-determine yung liquidity ng business. Tapos, when we say liquid here, it means something that can be quickly converted to cash. Kasi nga, di ba, kapag may utang na tayo, kailangan babayaran natin yun. And ano yung pangbabayad natin for those utang? Siyempre, yung mga assets natin, like cash, accounts receivable, ayan, ilan sa mga pwede natin ipambayad for our liabilities. So, some examples of liquid assets na makikita nyo din naman in the next slides are yung cash, basically. Cash on hand, cash on bank, deposits, basta lahat ng assets that can be quickly converted to cash. Ayun po. So, let's start with the formulas. Ayan, sana ready na kayong maka-absorb ng maraming formulas. But, for liquidity ratios, there are only 6. So, medyo kaya nyo pa ito. Ayan. So, the first one is the current ratio, which is calculated by dividing current assets by current liabilities. So, based on this slide, it is a primary test of solvency to meet current obligations from current assets as a going concern and a measure of adequacy of working capital. It basically indicates the extent to which current liabilities are covered by those assets expected to be converted to cash in the near future. Kunwari, ang isang company is facing or having a financial difficulty. Pag ganon, it typically begins to pay its accounts payable more slowly and minsan, hihiram pa ng uutang pa sa bangko, both of which increases current liabilities. So, kapag yung current liabilities natin is rising faster than the current assets, yung current ratio natin bababa. And that would be a sign of possible problems for the company. But please take note that for all ratios I am going to introduce, if you become a financial analyst in the future or someone that will apply these ratios, the result of computation is not its end. You need to check the components of such account to know the real reason as to why the result is like that. So, please take note of that, guys. Ayun. For the quick assets naman or acid test ratio or quick ratio, ayan, total, it is calculated by getting the total quick assets and dividing it by total current liabilities. The total quick assets is calculated by adding the cash, marketable securities, and accounts receivable from the current assets. So, this is a more severe test of immediate solvency. Yan, test of ability to meet demands from current assets. So, ayun nga, it measures the firm's ability to pay off its short-term debts from its most liquid assets without having to rely on inventory. Kung sa current ratio, kasama pa si inventory and other current ratios, dito naman kay acid test ratio or quick ratio, ano lang, yung mga most liquid assets lang, which is the cash, marketable securities, and accounts receivable. So, why do we eliminate here inventories? Because inventories are typically the least liquid of a firm's current assets. So, if yung sales natin nag-slow down or hindi agad-agad na bebenta yung inventories natin, medyo matatagal lang tayo ma-convert into cash yung inventories or yung sales natin kaysa sa ina-expect natin. Kaya tinatanggal natin dito si inventories. And also, inventories are the assets on which losses are most likely to occur in the event of liquidation. So, ayun po. Kaya tinatanggal natin si inventories with that. In other book, the formula for getting quick assets is current ratio less inventory. Kasi diba nga tinatanggal lang natin si inventory. That would be applicable only if there are no other accounts included in current assets. Kumbaga, ang meron lang is cash, marketable securities, AR, and then yung inventories. Yun, pwede mong gawin na i-less lang si inventories. But, if there are other accounts other than that, you need to eliminate it too. So, the easiest way talaga to get the quick assets or para matandaan kung ano yung mga quick assets is makabisado nyo kung ano yung laman ng quick assets, which is yung cash, marketable securities, and accounts receivable. So, ayun, paulit-ulit ako para lalo nyo matandaan kung ano ba yung mga quick assets. So, that is very important. as these are the one of the most common ratios used in analyzing financial statements, the current ratio and the asset test ratio or Q ratio. The next one is the working capital to assets and working capital. So before we go with working capital to assets, simulan muna natin sa working capital. So the computation for getting the working capital is basically getting the current assets and less the current liabilities. So the difference of that is the working capital. So this shows the short-term liquid assets available after short-term paid liabilities have been paid off. So it is a financial measure which calculates whether a company has enough liquid assets to pay its bill that will be due within the year. Then, kapag merong excess of the current assets na ipambabayad sa current liabilities, that amount can be used or spent to its day-to-day operations. Ayun po ang working capital. Now, let's go back with working capital to assets. Ito pa isa sa mga tatandaan nyo why it is important to na makabisado yung mga formulas. Kasi merong mga ilang formulas na connected sa isa't isa. Like ito, hindi mo makakukuha yung working capital to assets not unless you get the working capital. So, ayun, parang sa isang formula, hindi lang isang computation yung gagawin mo, dalawa. Ganun. So, ayan. For working capital to assets, it is computed by getting the working capital and dividing it on its total assets. So this indicates the relative liquidity of total assets and distribution of resources. So basically, it compares the net liquid assets to the total assets of the firm, and this determines the short-term company solvency kapag kinukuha po natin si working capital to assets. Last but not the least, last two of the liquidity of ratios under liquidity ratio is the cash flow liquidity ratio and the defensive interval ratio. So, cash flow liquidity ratio is computed by getting the sum of the cash, marketable security, and cash from operating activities and dividing the sum of that to the current liabilities. So, dito, meron namang nadagdag na isang account which is yung cash from operating activities, which can be pwede nating makuha yung figure sa cash flow. So, ito po, wala po siya sa balance sheet. Nandun po siya sa cash flow. So, isa pa sa need nyong matandaan is kung nasaan yung mga accounts na important. So, ayun, si cash nasa balance sheet, si marketable securities nasa balance sheet, then si cash from operating activities, siya naman is nasa cash flow. So, as a student, dapat familiar kayo kung nasaan yung mga accounts sa financial statements para kapag i-apply nyo na siya or magko-compute na kayo, alam nyo kung saan nyo kukunin yung mga figures. Kasi madali lang naman na mag-substitute kapag kakabisado mo yung formula. But the problem is, tama ba yung sinubstitute mo na figures? Ayun po. So, it is important to know that. So, cash flow liquidity ratio measures short-term liquidity by considering as cash resources, cash plus cash equivalents plus cash flow from operating activities. So, basically, ang sinasabi dito is yung sum nung nasa taas. So, the more mas malinaw na dito, definition for this is a more conservative variation in quick assets. It measures short-term liquidity without having to rely on receivables and inventory. So, ayun, cash na lang yung natira tsaka marketable securities. So, it measures how well a company can pay off its current liabilities with the cash flow generated from its core business operations lang. So, ano, hindi siya doon sa buong current assets, doon lang sa cash flow na na-generate from its core business operations. So this shows how much a company earns from its operating activities per peso of current liabilities. So kumikita ba yung company kapag tiningnan yung ratio ng mga cash versus dun sa current liabilities ng company? Ayun po. And last but not the least of the formula is pang-anim na. And ayun, sana okay pa yung mga princess niyo para mag-observe ng formulas. There are more to come. So yun, for defensive interval ratio, it is computed by getting the quick assets over the projected daily operational expenses. So ayun, paulit-ulit tayo. Ang quick assets is composed of the cash, marketable securities, and accounts receivable. So, for safe computation, mas maganda na kunin nyo na lang yung cash, marketable securities, and accounts receivable. Ayun po. So, defensive interval ratio measures length of time in days the firm can operate on its present liquid resources. So, this reflects the percentage of near cash items to the daily operating cash flows. So, basically, defensive interval ratio indicates how many days a company can operate without needing to tap into the capital resources or its current assets. So, more on, hindi siya magre-rely doon sa mga capital resources ng firm. Kung parang tinitingnan lang ko ilang days na kaya ng company na mag-operate without needing to get sa capital ng firm, but on its quick assets. So, that is all the formulas under liquidity ratio. Now, let's go with its application para mas maintindihan. Ito na, nandito na tayo sa exciting part.